string of Chinese mining and metal companies are actively pursuing investments overseas, hoping to take advantage of low commodities prices. But as Liu Ying reports, while falling prices have made some overseas assets quite attractive, analysts are warning of the various risks associated with cross-border acquisitions, and they suggest Chinese buyers should conduct due diligence to mitigate those risks.
With international commodities prices at a 6-year low as a result of the global credit crunch, cash-rich Chinese companies are seizing the opportunity to shop abroad. Chinalco, China's largest aluminum producer, clinched the world's biggest deal in the mining sector in 2008 by acquiring a 12% stake in Australia's Rio Tinto at a price of $14.3 billion. A few Chinese companies have followed suit. A recent report by international accounting firm Ernst & Young shows the number of acquisitions by Chinese firms increased by 62% in 2008. Nearly half of the 89 deals were outbound transactions.
The current market situations, of course, have created once-in-a-lifetime opportunities for Chinese companies that are cash-rich to exploit the low asset price in the development countries. A strong renminbi is making the foreign resource assets even more attractive and cheaper from a Chinese perspective.
But Ernst & Young's analysts warn of the various risks associated with cross-border transactions, such as political difficulties, cultural differences, human capital, and post-merger integration. And their experience data shows that globally, only 1 out of 4 cross-border transactions is successful.
If you look at those giant resources companies that recently become affordable acquisition targets to Chinese companies, they're actually the companies actively had made acquisitions financed by debt in bull market phase. And if you look at them now, they're swimming against a tide of debt repayment schedule. And so you can see the cross-border transactions can actually drag the companies into deep problem if they were not done properly.
Ernst & Young analysts suggest Chinese companies exercise strict discipline when it comes to M&As and carry out due diligence on their investment targets to avoid overpayment and to ensure successful transactions. They predict with government support, Chinese firms will continue to be active in pursuing overseas acquisitions. Liu Ying, CCTV.